Hello investors, welcome to Simpli Stocks. The Q4 earnings season has started and most of the companies have released their business updates. So in today's video, I'll talk about good business updates that have been announced for the March quarter. Now this Q4 earnings season is going to be very important and the commentary from companies management will also be very critical. We will get to know how different businesses are impacted by the war and how they are dealing with this crisis. And the this earnings season is obviously also coinciding with a market bottom that makes it even more special. Companies that announce strong results and where management commentary is also good, we can come across good opportunities in those businesses. So if you are a serious investor, you can subscribe to my channel Simpli Stocks. My name is Vikalp Mishra and I am a SEBI registered research analyst. On my Simpli Stocks channel, I regularly cover good businesses and trending sectors. In today's video, we will look at businesses from retail, jewelry, steel, banking, and also NBFC space where updates have been strong. And then as results start coming in over the next few days, I'll also be analyzing them and posting videos. I'll be posting videos on them as well. But yes, before starting the video, as a standard disclaimer, I might be invested in some of the businesses which I'm going to discuss today, or they may be part of my research desk tracking list. So this is not at all a buy or sell recommendation. That is my disclaimer. So please keep that in mind. With that, let's get started. The first business with a strong update is V2 Retail. Their sales in the March quarter, Q4 quarter, that is in the months of January, February and March, have grown by an impressive 59% compared to the last year. That is good. But this time there has been a lot of discussion around V2 Retail's SSG as well. Let us talk about that. So same store sales growth came in lower than expectations. You can see here that SSG has been 7.7%. SSG basically means how much the sales of existing stores have grown compared to the last year. Take it like this. The sales coming from new stores are separate, but how the existing stores are performing tells us about companies standing in the market. One reason for this SSG or low SSG is that V2 is opening new stores at a fast pace, which is distorting the consolidated SSG. The lower SSG from newly opened stores is averaging out the overall consolidated SSG number. Some also have the opinion, some people also have the opinion that the company has done reckless expansion. My view is that in the market, in a bear market, you will see always narratives get framed. A year ago, when the market was doing, say, decent, or when V2's stock was performing well, the same SSG would have been ignored, honestly. And people would talk about store expansion and top line growth, saying that SSG will improve later and that is not of a concern. But now, since the stock is under pressure, analysts have become overly cautious and even small issues are being exaggerated into bigger narratives. And even if we assume for that sake that company made some mistakes in expansion, then you should also see that business is growing at 50% rate. And even if there is a 5 to 10% error rate, then you need to allow that much room for error at least. Plus, when a good business goes through a rough patch, you should support it, because when you invest, you are not just investing on the numbers, right, but also on the management. If there are short-term issues, it is management's job, or the management will take the necessary steps to fix those issues. So you do not have to be concerned. Therefore, I will say that V2 investors should not worry too much right now. You need to wait and watch for 1 to 2 quarters, and overall these are still very good numbers. Now after V2, the second business that we will study, or where the top line growth is good, is GSM Foils. GSM is a micro cap company in the pharma and healthcare ancillary space. We also closely track this business in our Simpli Stocks community. They manufacture these medicine packaging foils for pharma companies. And what I like most about GSM is that despite having a small market cap of around 280-300 CR, the quality of the management and investor communication is very good here. This is something you won't even find in many small cap companies. In Q4, their sales grew by 80%, and as this video was being recorded just before the video, I saw that they had also announced their results. So the PAT growth is also 80% plus. This should boost the overall valuation and perhaps the scrip price too, because the stock, it is still at 15 to 20 PE range. They recently started a new manufacturing plant, which has supported this growth, and as capacity utilization increases in this new plant, we will continue to see strong top line growth this year as well, that is in FY27. Now, a humble request just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where I bring multiple such videos every week. Honestly, I keep saying and you don't do that, but see, your likes and subscribes are our only motivation, so that we keep working hard for you and we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Now, coming back to our discussion, let us look at jewelry companies. Here, almost all players have reported good numbers. Like you will see here in this screenshot that Senco's sales have grown by around 46%. No one could have anticipated that. They have also increased their store expansion and sales guidance, and the company is now targeting around 20 to 25% growth. If you check on a screener, Senco might look attractive to you. It is trading at a PE of just 10 right now. But I must tell you that there are also some issues here that you need to consider. And the main risk is that even if the company reports good sales growth this year in FY27, we may still not see growth in net profit or EPS. Last year, they benefited from 2 to 3% inventory gain in their net profit, which will not be there this year. And that benefit was because of inventory gains arising from under hedging of inventory. In the jewelry sector, there is a concept of hedge ratio, meaning what percentage of your inventory is held. Good managements usually hedge most of their inventory because you never know when gold prices can correct or fall sharply, right? And gold prices increased last year, so that benefited Senco. But prices will not keep rising every year like that. In fact, you will see gold has also corrected around 15% from its peak. So there is a chance that we might also see inventory losses in Q4 because of this under hedging. We will see when the results come out, and that can be a problem. Plus, the debt in Senco is also rising, and they don't have that good what we call inventory turnover ratio. Like, it is not that efficient player when we compare it to Kalyan, Titan, or even say Gadgil. So I don't expect any PAT growth for Senco in FY27. And even on the forward basis, then PE remains around 10 as their current PE, which is their current PE also. So, and you will see there is a close peer, PN Gadgil, which trades at around 15 forward PE ratio. So considering management quality of PN Gadgil, growth prospects, and the risks which are there in Senco, I would personally prefer paying a premium for Gadgil over Senco than buying Senco hoping is it in value zone and it turns out to be a value trap. So I will be comfortable paying a premium for Gadgil, because you will see that even PNG's numbers have also been strong for Q4. Their retail sales have grown by massive 102%, or basically we can say sales have doubled from the last year. While the gold price rally helped, what is interesting is that the volume growth has also been very healthy. Volume growth was also in the mid-20s, and that is something very nice. Plus, they have also increased their growth guidance from 20 to 25%, and they are targeting 13,500 CR in sales for this year. So these are good numbers. Along with increased guidance, we should see some improvement in the overall sentiment for the stock, because what happened was after the Q3 results, the management had reduced guidance during the con call, which badly hurt the overall sentiment around the stock. But anyway, these are good numbers, and if there are no further negative surprises, this business should do well going forward. Now, moving to the bigger players, Kalyan Jewellers has reported strong sales growth of 64%. And also the market leader has delivered very strong numbers as well. Their domestic jewelry sales have grown by 46% year on year in Q4. The market has also rewarded Titan's stock after seeing such strong numbers. Titan is currently trading at its all-time high, while other jewelers from PN Gadgil to Kalyan, they have corrected significantly and are trading at heavy discounts. So that is very interesting actually. Plus, it also makes a strong case for the likes of Kalyan and Gadgil, and there is a clear, evident valuation gap and PE relating opportunity for Kalyan, Gadgil, and all. And lastly, there is a new company. Let us talk about that as well. It has been recently listed, PNGS Reva Diamond. This is part of PN Gadgil Group. It operates SIS, meaning shop stores within Gadgil's stores. Like if you would have visited jewelry stores of Malabar Kalyan or Titan, you would have seen or noticed different sections or floors for different categories, like separate sections for diamond jewelry and separate sections for silver jewelry. So what PM Gadgil has done, that it separated its diamond business and listed it as a separate entity and raised capital from the market for its expansion. Now, their target is to move beyond the SIS model and open their own dedicated, full-fledged diamond jewelry stores. But see, the risk here is that as soon as the company starts launching its own stores, the margins will drop significantly right now because many costs are shared with PM Gadgil. Another important point is that people who are getting excited by just seeing this 97% sales growth are ignoring the risk from the lab grown diamonds in the diamond segment. And because that risk is there, and when the results are announced and the con call happens, you need to carefully listen to what management has to say about lab grown diamonds, because that is a risk. And globally, LGD jewelry is taking away market share from natural diamond jewelry. And even in India, many lab grown players are entering and they are expanding. So that risk is there. You cannot ignore it just by disregarding it. That is not right. And I am myself invested in a lab grown diamond company, so I know the industry dynamics. They are not in favor of natural diamond jewelry. Now, moving forward from the jewelry businesses, let us look at companies in the iron and steel sector. Overall, the pipes and tubes companies, they have not reported very strong numbers. In fact, this segment has also been struggling for quite some time now. So that is there. JTL's numbers have been surprising here, but it remains to be seen whether this is just one-time thing or if something has actually happened in the company. Also, we will get a better idea about pricing trends during the con calls of these companies, because poor pricing in the steel tubes and pipe segment has hurt the margins of almost all players. What's surprising is that even Sambhav's numbers were also not very impressive. While there has been growth in the there has been a volume growth in the value-added category. If you look at the bulky steel tubes and pipe segment, their growth is even lower than JTL, which is a bit disappointing. But the positive development in the sector is that slowly pricing power is coming back. So what happens is, in such a scenario, integrated players, meaning those companies that have their own mines and also process iron and steel themselves, they can perform well. And one such company you can look at is Lloyds Metals and Energy. Their recent capex has gone live. Because of that, company has reported strong volume growth. Iron ore output has increased, and along with that, there has been good growth in DRI and pellets as well. I had shared this update in our Simpli stocks community as soon as it came out, and since then the business has also been trending. Now, moving forward, in banks and NBFCs, the overall updates are decent. Once the results come out, we will get more clarity on how the environment for MSMEs and consumer loans is shaping, the way war is happening, how the sentiment is. Now, CSB Bank has reported a good update. It is a gold lending stock or business that we track in our community. You will see that gold loans have grown by 53% for CSB, which is very good. And it has led to overall 27% growth in advances. In Q3, there were some asset quality issues here, but hopefully they should come under control in Q4. We will get a clearer picture once the results are out. And in the broader lending space, the microfinance sector has made a strong comeback. If you look at any microfinance lender, whether it is Ujjivan or Utkarsh Small Finance Bank, Credit Access Grameen, or Satin Credit Care, all of them have shown improvement in asset quality and have also resumed disbursing microfinance loans at a fast pace. Also, you should not judge these businesses only based on the PB ratio or PE ratio, because last year the entire sector went through a downturn. Now here you need to look at the direction of the business, because PE multiples will paint a very overvalued picture, but that is not the case, because last year there were no profits, sector was in downturn. You need to look at the direction of the business and also look at what proportion of their total loan book comes from microfinance, because companies with higher MFI exposure are better businesses for you if you want to play this cycle. Because what happened was, many lenders like IDFC First also reduced their MFI books a lot, and that is why I personally don't like Equitas as much. In comparison, Ujjivan and Utkarsh have higher MFI exposure. In fact, around 50% of Ujjivan's loan book is in microfinance. At the same time, if you look at Satin Credit Care, it has also done well its disbursements have grown 43% year on year and 37%, mind you, quarter on quarter, while AUM has increased 14% quarter on quarter. Similarly, Ujjivan Small Finance has also reported 31% growth in overall disbursements. Disbursements basically mean how many new loans are being given. So their core microfinance, in their core microfinance segments, group and individual loans, these two segments have grown 40% and 16% year on year, with around 12% quarter on quarter growth. Asset quality has also improved. The same trend of improving asset quality is also visible in Credit Access Grameen's update. Here as well, you can see that portfolio at risk or PAR buckets have improved. You can think of PAR as something that turns into future NPAs. So what happens is, if PAR is improving, it means the company's asset quality is getting better. And they have also reported good growth in disbursements. And yes, remember please that microfinance is definitely a high margin segment. The opportunities are good here, but at the same time, this is also a very risky segment. Even a small amount of stress in the economy can impact this sector significantly. So don't rush here. If you want to build positions, make it a gradual exercise. In microfinance lenders, do it gradually. There is no need to hurry. Slowly, I will say, spread your allocation over a period of next 3 to 4 months, depending how the results and updates are coming and what is the commentary of the management. Lastly, before ending the video, let us quickly talk about automobile companies. The auto sector had good numbers in January and February, but in March we did not see those strong numbers in the commercial vehicle segment. This could also be due to the impact of war, because when there is so much uncertainty at global level, the natural response is to delay big expenses, because we are seeing everything from gas shortage to even rumors of fuel shortage, right? But in the two-wheeler segment, TVS and Bajaj have performed well, but valuations there are not very comfortable. Hero's numbers were not very good. They were not good. They were not strong. Ather, however, has delivered standout numbers. You can look into the business. We have already covered Ather 2 to 3 times on our channel. This company has been consistently gaining market share, and its sales have grown by 100% year on year in Q4, because the rumors around fuel shortages were in Ather's favor. And if you know someone who runs an Ather showroom, you can ask them. Everyone will tell you that in March, they sold way more units than their internal targets. And if you have been following the news, the Delhi government has also introduced a draft EV policy, under which ICE two-wheelers can be banned after 2028. So that is also a big trigger. Only new EV registrations will be allowed in Delhi, because if that happens, it will be a big trigger. And even though the business is currently trading at its all-time high, there is also a loss to profit story that is playing out. So don't look at valuation, because there is no concept of valuation here. You have to look at business scope and the way costs are coming down, margins are improving because of the scale. So you can look into this business on your own. It is a good business. Now, if you did not like the video earlier, please make sure to hit the like button now. Along with that, you can also subscribe to our channel Simpli Stocks. The earnings season has just started, and in the coming days, I'll be bringing you more such commentaries on many good businesses. So I'll see you in the next video. Don't forget to like and subscribe. Happy investing.